One of the major worries for many in the aftermath is who pays for the rebuild in an area of the world known as paradise on earth, and with it some of the highest real estate costs as well. An average property in the Pacific Palisades is around $4 million. Many fear that the insurance policies will not cover the cost and they'll be left to exposed to California's faulty insurance market. Let's hear from some of those who are worried about what comes next.
Hopefully the insurance can pay for, most of it. If not, then we're going to have to stay with friends or someone. Our house was estimated about 1.3 million, and now it's all gone.
I know so many people who live in and around the Palisades, are people that I'm working with on the crew here on the film now have lost their homes and families lost homes. It's devastating, and I think catastrophe on so many levels. Yeah, but just kind of seeing it now, and obviously with the time change, I haven't spoken to anybody else, but I have a friend who was working on the film today. Just told him that we would be praying for his family, and everybody's out safely, but to lose everything, and because there have been fires going on for so long, a lot of people no longer have wildfire insurance. So I think the devastation of losing all your belongings and losing everything is very real for a lot of people.
Interesting. Mark Wahlberg, the actor, talking about not a lot of people having wildfire insurance. We've heard that a number of times on France 24. Let me bring in Michael Wara, senior researcher for climate and energy at Stanford University, who's in Stanford, a wildfire expert. Great to have you on the programme, Michael. Great to talk to you. First of all, just set out to us the difficulties, because I think I'm right in saying that there are effectively laws brought in California to stop insurance companies actually having any model-based estimates on catastrophic risk. And therefore, we've seen a number of insurance companies leave, and therefore it's made the situation a lot more difficult for people.
That's right. Since the fires that people may remember that occurred in California in 2017 and 2018, insurers have been asking for much higher prices, which makes sense. The risk is higher than they thought, and there's been a lot of pushback on that. As a result, over the last couple of years, insurers have been pulling back non-renewing customers, kind of firing their own customers, and also refusing to accept new business. And as a result, many people have been pushed into the insurer of last resort, known as the FAIR plan, which has coverage limits at $3 million, which sounds like a lot of money, but as you just heard, many homes in Pacific Palisades are worth $4 million and up. And many people also, because of the increasing cost of insurance, are effectively underinsured. The gentleman that was just talking on your show that said his home is worth, 1.3 million. Maybe many people, I think, have policies that will only cover $1 million. And so they're going to find a very large gap as they try to reconstruct. That's going to be made even worse by the fact that we've lost somewhere above 10,000 structures in Los Angeles. And so there's going to be a shortage of skilled construction labor as people go to rebuild. And experience from other California fires suggests that the reconstruction costs after a catastrophe like this may be 50% higher than people expect. So I think there are going to be a number of challenges for many people as they try to recover from this fire. And the other issue that I think many of us are concerned about is what the impact of these losses will be on the broader insurance picture in California. The regulator has been trying to address some of the deficiencies, one of which you mentioned, the fact that companies have been unable to estimate risks, or not allowed to estimate risks using catastrophe models, these complicated, computer models that are used to factor in things like climate change. That's been a process that's been ongoing in California, but I think this disaster is really going to outrun the steps that have been taken so far.
It's very interesting. So it's a double hit in terms of those who've lost their properties, and as you say as well, we're going to see for those who have got standing buildings, and across LA was already suffering a big housing shortage, a premium on their insurance already. Let me read this to you, Michael, because it's something that you touched upon. When we're looking at the big insurers, we have, back in 2022, Allstate, California's fourth largest home and casualty insurer, stopped selling policies. Then we go to March State Farm as well, another insurance, cancelled 30,000 home insurance policies, including 1,600 in the Pacific Palisades. That was back in March. So both firms talk about the risk of losses from wildfires for pulling out of the market. So that is a big issue. The other thing that you raised is what they're reliant on, many of those who've since bought insurance there for their properties, is this FAIR plan. So it's a non-for-profit outfit. Is that right? They will allow an exposure up to, is it 3 million, you said, per potential claim?
That's correct. The coverage limit under the FAIR plan is $3 million. Another issue for the FAIR plan is that given the scale of the catastrophe in Los Angeles, and the fact that it occurred in places where where the regular insurance companies have been pulling out, and that means that people have been going to the FAIR plan. The FAIR plan faces a risk, I think a real risk, of running short of resources to pay claims. And so if the FAIR plan were to not have enough money to pay the claims that it's obligated to pay after a fire like this, it has the legal authority to basically tax all of the insurance companies that are left in California, and that may further destabilize the market. So essentially, if the FAIR plan needs $1 billion, it can ask all the insurers in California to contribute their share of that $1 billion, and they will pass that cost through to their insurance policies.
But here's the difficult balance then, isn't it, Michael? You've got the need to have a premium and a business need to have a profit. And if there's no profit, there's no reason to be there. I have heard some analysts, I don't know your thought on this, saying that there needs to be some kind of federal backstop, because the common news that we're hearing all the time of wildfires and natural disasters, it's no longer a profitable business for many insurers.
Yes, well, I think that, something we haven't talked about, which actually is kind of the heart, in some ways the heart of the problem, is that these kinds of catastrophes, insurance companies have their own insurance to manage these kinds of massive catastrophes. That's known as reinsurance, so sort of insurance for insurance companies. And the reinsurers are really offshore global entities that are not regulated by California or even the United States. And so if they pull back, which is the thing that is, I think, most likely to occur, if they say, we're going to only sell insurance to insurance companies for catastrophes at much higher cost, and we're going to have much, higher deductibles on that insurance. Those deductibles are called attachment points in the industry. That could have really destabilizing effects on the insurance industry, lead to much higher premiums. Premiums like we see in Florida for hurricane, where in some homes in Florida pay as much as $40,000 to $70,000 per year for insurance.
And I guess
that would be very stabilizing to the property market here.
If we talk about previous times gone by, back to Hurricane Katrina, and at a time where we were hearing on a world level perhaps fewer number of natural disasters, and that seems to be borne out, doesn't it, by the figures. I think in the last 5 years we've seen insurance losses of higher than 100 billion each year, which is a huge toll. So what does that mean on a world level with dealing with insurance and dealing with where people choose to live?
Well, I think the first thing to say is that we need to reduce risk. We cannot insure our way out of this problem. We actually need to make physical changes to our communities, to our homes, to make them more resilient to disasters like the one we see unfolding. And there are things in California that we can do to make California communities much safer. There's still going to be risk, and it's going to grow because of climate change. And so recovering, insuring and managing that risk is going to be increasingly challenging. And there may have to be a public role. We'll see. My view right now in California is we need to let the dust settle and then really seriously evaluate the question of whether we have an insurable risk going forward that is both that can be made affordable to regular people, because it's fine to have available insurance, but if it costs so much money that normal people like the ones you've been interviewing cannot afford it, that's actually not a solution.
Yeah.
And the government may have to get involved.
Michael, really good to talk to you. Really good to hear that context as well. Michael Wara, Senior Researcher in Climate at Stanford University. Thank you.